Madame la Marquise, tout va bien. Allez.
Well, good morning. It's amazing how 1 month can change the whole picture. I was quite depressed, as you can imagine, like many of you in January, and now we're all feeling better. So we'll start this with a little song.
Allô, allô, James? Quelle nouvelle? Absente depuis 15 jours. Au bout du fil, je vous appelle. Que trouverai-je à mon retour? Tout va très bien, Madame la Marquise. Tout va très bien, tout va très bien. Pourtant il faut que l'on vous dise, on déplore un tout petit rien. Un incident, une bêtise, la mort de votre jument grise. Mais à part ça, Madame la Marquise, tout va très bien, tout va très bien. Allô, 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 ah, allô, allô, Martin, quelle nouvelle?
Okay, you get the idea. How do I switch this? Can't get out. Anyway, oh, here it is. Okay. Well, you all know this famous French song. It was a great success. It was created by the Ray Ventura Orchestra in 1935. And it's basically making fun of the French government, who was always so optimistic in the face of the rising threat of Nazi Germany. So of course we're not in such difficult times today, but you've seen, you will agree with me that a lot of the optimism of our governments are maybe a little overrated. So for this presentation, I'd like to come back to a few slides that I showed back in the dark days of November 2015, where I was foolish enough or brave enough to be extremely bullish on gold and gold mines. Then we'll see, we'll go through some of the fundamentals for gold. I think the fundamentals are still very bullish for gold. Nothing has really changed. And the key question, of course, is this upward thrust the real thing, or is it going to do like every year, just go back down? And as investors, every day is always very difficult, because what do you do after such a rally? So my presentation at this last conference was to stress historic opportunities on gold and gold mines. It was a disaster for gold mines. They were down 90%, but gold was still behaving as a real asset class. And my major point was to point out that that gold was going up in most currencies, and that gold should follow in dollar terms. And the gold mines were so depressed that they were a massive opportunity. The strategy for conservative investors was to go back to Swiss common sense and put 10% in gold. But the big opportunity, of course, was in the gold mines. These gold mines felt very risky, but they have been stabilizing and forming a base. It felt good to own Apple, but as we saw recently, things have been turning around. So GDX, the gold mines index, was forming a base. And that base was at so low levels that I dare to say that you could buy and timing had no importance. Because if an asset is going to go up, it's going to double or triple or quadruple or go up 10 times, it doesn't really matter if you have to wait 1, 2, or 3 years. Luckily, we didn't have to wait that long. So we were already in November in a sort of a stealth bull market, where some stocks and I think one of the first stocks to turn around was Nova Gold. So people say qualities go up first, and this stock started to go up in 2013. And here are the companies that I had stressed at the last show, and they were all making bases or had already turned around. And since the last conference, here are the results, which proves that coming to a Bailly conference is not always a bad idea. Anyway, I'm not here to brag about the fact that I've been bullish last year, because things are never as simple. And if you had followed my same strategy, accumulating from August till December, you probably maybe added like I did when this little triangle here was broken on the upside. So that was very encouraging. Gold was doing fine. And then gold didn't do new lows, so everything looked fine. But then the gold mines collapsed. And it was a very difficult January. If you had customers there, maybe they would have sold at the wrong moment. Anyway, after that, it was just one direction, up. What had changed? Really not much. Fundamentals on gold have been bullish for at least a decade, maybe more. And nothing has really changed. So we'll go over, some of the key elements. Debt, budget deficits, the dollar, big physical buying on gold, portfolio rebalancing, that's the new thing, and a deteriorating geopolitical landscape. So today, the governments are, tout va très bien, Madame la Marquise, but is the world really much safer now? Global debt levels are rising pretty much everywhere. As you know, the Federal Reserve debt now is 2.4 trillion. Nobody can understand how big these numbers are. Chinese debt to GDP is an astonishing 282%. Fiscal deficits are widespread. The Chinese banking system is bankrupt. Economies around the world are rather weak. And the overall level of foolish practices and accounting tricks is at all-time highs. So the dollar has had a nice run, but if you look at it in the context of the broader picture since, let's say, the 70s, we've had these huge rallies. They're more like counter-trend rallies on a fundamentally weak currency. Of course, when the dollar does do these big rallies, gold suffers. Now, the dollar isn't such a great currency because the trade deficit is still enormous, and it will probably rise again. The dollar is overvalued in many currencies, and if you go to New York, it's not the shopping paradise that I have enjoyed in past decades. What has changed a little is portfolio rebalancing. The traditional assets now look more risky and less promising. Real estate has probably peaked in most countries. If you look at even high-end real estate in London, which was supposed never to go down, they're down quite a lot. Even here in Switzerland, high-end real estate is down, I think, something like 20%. The yields on the bonds are at historic lows. I can't even understand why they're so low, but it's not very promising for future returns. Equities have shown some pretty much downside volatility, and oh, by the way, I see here there's someone from Equinox, and I'd like you to introduce a person from Equinox. They're one of the most famous hedge fund managers in the States. They've had stunning returns. And I'm mentioning that here because because they're so thorough in their value analysis, they're able to short stocks, and they were quite successful at it. They shorted the tech bubble, and their returns were astonishing. From 2000 to 2010, I think they averaged something like compounded interest rates of over 20% a year. So it'll be really interesting to hear their talk this afternoon. Cash is not very sexy either, especially some governments are playing around with the idea of suppressing cash. The physical demand on gold is still extremely good. You know the figures on China. Governments are still buying physical gold. And a new factor is the new inflow in ETFs. If you take the gold ETFs, the big watershed was 2013, where it dropped 870 tons. And this quarter alone, we're back up. Their stock increased by 274 tons. So this is quite a change. An interesting piece of news that I've read March 16th, and this could be extremely important, is a conservative insurance companies has said that they were buying gold, and this is Munich Re. So this is not, some type of speculator like myself buying a few shares here and there. We're talking about real serious money. So if pension fund starts to consider gold, we're looking at much, much, much higher prices. The political landscape is deteriorating. We've all been bombarded with these refugee crises, terrorism. There's this overhang on the markets with Brexit that could happen June 23rd. And most importantly, there's a huge rise in xenophobia and populism a little everywhere. And that is not usually very good for economic growth. The Middle East is in turmoil. So here again, the fundamentals are not terrific. But tout va très bien, Madame la Marquise. And so the question now is this upward thrust, which has been spectacular, is it sustainable? Is it just another fake out? And historically, I have been pretty good in calling a few bottoms, and I've been pretty bad in calling the tops. And so the question here is this a reliable breakout? Is this bull market for real? So I have a few arguments that to me show that the probabilities are on our side. First of all, gold is up in all currencies. Secondly, this bull market has started in a very spectacular fashion, and gold mines are still very, very cheap. Gold is up in all currencies, quite substantially from the lows. So this is the chart of gold in the ruble. It would be even more dramatic in the South African rand. Gold is up for producing countries. This is gold in Australian dollars. And that, of course, is extremely important for our gold miners because their profit margins are way up. Even against the Swiss franc, gold is up 16% year to date, and that's much better than negative interest rates. In the euro, the low was at the end of 2013, and you see we have a nice bull market developing here. And finally, what we have been all waiting for such a long time, gold in US dollar has finally broken out, and it's on the upside. Now, old timers, market technicians, and we lost one of the most interesting technical analysts. Ian McAvetti died a week ago, and he was always saying that bull markets start with a bang, and this has been a bang. This is usually the signature of a long, sustainable good bull market in any type of currencies or asset. Here you have the histograms of what has happened in the last couple of years. So in the dark you have the gold price increase in the first quarter, and in light gray it's the advance in GDX. So as you can see, 2014 we had a pretty nice run up. It made us all optimistic, and then we had new lows. 2015, same thing. This year it's even more convincing. So I would say the probabilities of making new lows after this is quite low, and especially that coming back from PDAC, I can tell you that people are still very worried, including the professionals, that we might have another leg down to $900 or so. Of course, nothing is impossible, but the fact that this fear is still around, probably from a behavioral sense, means that we probably won't get it. So these are the thrusts that were experienced in the last two bull markets without significant corrections. In 2000, plus 82%, 2003, plus 82%, plus 95% in 2004, and in 2008, plus 77%. So you see this big thrust is not unusual in our difficult and volatile market. Here you have a long-term chart of gold versus gold mines. And here from the chart dates back to the 80s. So for 30 years you had a band between 3 and 6. The more the chart goes up, it means that gold is doing much better than the gold mines. So you were in a band for 20 years, and in 2008, during the crash, you broke out on the upside. This helped me tremendously and gave me the courage to buy end of 2008, beginning of 2009, because this was so unusual statistically. Of course, this has been at my disadvantage, because since the ratio went berserk, I was overly optimistic on the gold mines. But after such an excess, a reversion to the mean is probable. I don't think we'll go back into the previous range, because I think structurally mining is more difficult than in the previous decades. So the question now is, how do you invest after such a rally? And I tell you, I don't have the definite answer. I wish I had, but I will give you a few ideas I'm implementing myself. And if you have other ideas with less risk and more upside, please let me know when we talk together a little later. So the first thing is, of course, when we see something is up 76%, we don't want to buy. But we have to remind ourselves of the context. It's down a lot. I remember the start of the bull market in shares in 1982. I was starting to read Barron's. I knew practically nothing about the stock market. And they said in Barron's it's the beginning of a bull market, so I bought a few shares. And then it went up 30%, and I was really happy, and I sold. I had no idea of what a bull market was, and you know what happened from 82 to 87. So when a bull market starts, it can last very long and give you immense returns. So here are a few ideas. Dollar cost averaging, buy the dips, buy very leveraged plays, buy silver, buy quality smaller companies. So this is probably the most conservative and the best methods because it reduces risk dramatically, and it's just to dollar cost average into the gold mine space buying funds. The advantage of buying funds is that you're less likely to press the sell button too quickly. Here I've put the performances year to date in dollar terms of a few good funds which have presented here already. And so you have gold 2000 plus 62%, global gold and precious plus 51, Tocqueville plus 34. So that's not as good, but in the last bull market, Tocqueville has outperformed massively. So I think they'll do this the same way, and I think it'll be very interesting to hear their presentation a little later here. So one of the strategy is to go for leverage. The stocks which have gold in the ground, massive deposits, but who need much higher gold price to work out, are still not the favor of the moment. Today, people are buying the low-cost producers, the big mines who have profits, who have big margins. But of course, they will not do as well as the leverage play. So this is a space where there is still value. So Nova Gold, you see the bottom was in 2013, and now it's starting to edge higher. They're speaking a little later. I think you should definitely look at that. That's an easy buy and hold stock. And there's no risk in production. They have no production, which is a huge advantage. And if gold doubles, this thing can go up 20 times, which is not bad. Another idea would be to look at silver stocks. Silver has underperformed gold massively. And here you have the ratio of gold to silver. So you see this ratio fluctuates between, let's say, 10 and 100. And during the bull market, silver went to $50, and this ratio was at 50 in 2011. Now the ratio is around 80. Every time there's a bull market, silver outperforms gold. So it's a pretty easy trade. I believe this ratio can easily revert to 50 and maybe 15. 5 minutes. Okay. Well, Mag Silver. They come here to this conference very regularly. This is quality. It's the only stock I know that's at the level of 2011. They have a joint venture with Fresnillo, one of the best silver operators, probably the best silver operator in the world. And they have made a huge discovery on top of that. Pan American Silver, this is a diversified, big, well-run company. They have 7 producing mines. But the key thing here is that they could double production. This is not in the price. Why? Because this is Navidad. It's in Argentina. But the probability that the new Argentinian government give them the authorization to go into production is pretty high. I think they'll get this within a year. If that is the case, this already big company can double. This is not in the price. The analyst puts 0 in terms of NPV for Navidad. Alexco. This is a past producing mine. they've made a discovery on site, which will triple NPV. The stock is way down. They can go back into production by spending something like $20 million, which is very small. So this has huge upside. It could be a 10, 20 bagger pretty easily. Maya Gold, the stock is depressed because silver went back down a bit, and then they're doing a private placement. Nevertheless, the market cap is $20 million, which is the price of their mill. They have put back into production their Zgounder mine in Morocco, producing 600,000 ounces. They can increase this quite easily. And on top of that, they have a huge past-producing polymetallic deposit. So this is huge, and you get everything for free. They will be closing this private placement this week, so I think this stock can easily double in the next couple of weeks, maybe month, and then with a little luck, you have a 10-bagger. The quality smaller companies are much better to own than the big stocks. The big stocks are not very well run, as you know. They're rather bureaucratic, and they're more expensive, whatever metric you use. Here I used a metric recently put out by BMO. They're trading at 2 times NPV, whereas smaller producers at 1.2. So it's great that you're here at this conference because the people presenting here are in this category. There's more growth and there's more potential. Balmoral will be speaking here. They have a nice nickel resource and a high-grade gold project in Abitibi. Here again, you see a nice little break of the downtrend, and you have huge potential. Strategic Metal. This is a nice stock that you can buy now because it's low risk. It's a project generator. It's in the Yukon, good jurisdiction. They have high holdings in Attack and Rockhaven. They're not spending their own money on projects, so it's relatively stable. And in a bull market, it can fly. Teranga Gold, I know nothing about it, but it has a nice little breakout on the chart, so I figured I'd put it here and we'll listen to their presentation. Another way to skin the cat is to go for takeovers. True Gold presented in November, and now the stock has quadrupled and they're being taken over. Sabina Gold and Silver. I had the pleasure to introduce them at this last conference, and I said that the CEO had the best voice. I called him the voice. I hope I didn't aggravate him, but my belief was that it could get their stock up, and his wonderful voice did it. It tripled. It still can double and be taken over. Almaden Minerals is my biggest position. It's a very low risk entry point now because they have 5 million ounces or so. They have nothing to spend. They just will be waiting for somebody to take them over. They've recently announced a pretty good PEA, which on a smaller scale would make it economic at current prices. Kaminak is an institutional favorite. They have high grade, and it will be taken over probably this year, and it could be an easy double. Voilà, so here are a few ideas to enjoy the Tout va très bien, Madame la Marquise. Thank you very much, and if you have other ideas, please let me know, because it's never easy to find a good way to play a good bull market.
Thank you, Claude.